Hello and welcome to all my international investors. So in this video, we look at 4 core valuation ratios every value investor should know. P to E, EV to earnings, price to sales, and price to free cash flow. These ratios help you decide if a stock is underpriced, fairly valued, or simply too expensive. The price to earnings ratio tells you how much you are paying for every rupee or dollar of the company's earnings. For a value investor, it's one of the first numbers to look at because it quickly shows whether the market price seems high or low relative to the company's earning power. A low P to E often means the stock may be undervalued or ignored by the market. A middle range P to E usually suggests the price is fair, and a high P to E means you are paying for future growth, not current value, which may reduce your margin of safety. But a good value investor never relies on PE alone. You always cross-check free cash flow, debt levels, and long-term consistency of earnings. EV to earnings shows the real economic price you are paying for the entire business because enterprise value includes both equity and debt. This makes it more accurate than the PE ratio when a company has significant debt or complex capital structures. Enterprise value is calculated very simply. It equals the company's market capitalization plus total debt minus cash and cash equivalents. A low EV earnings ratio can mean the whole business is selling at a discount. A moderate EV earnings ratio can indicate fair value. A high EV earnings ratio means the market expects strong growth and is already pricing it in. For value investors, EV earnings is crucial because a company with high debt can look cheap on a PE basis but actually be expensive when viewed through enterprise value. EV earnings helps you see the true price you are paying for the entire business. The price to sales ratio tells you how much investors are paying for every rupee or dollar of sales the company makes. It becomes very useful when earnings are inconsistent, negative, or temporarily depressed, but revenue remains steady. A low P to S ratio may indicate undervaluation, especially if profit margins are improving or if the company is recovering from a difficult period. A medium P to S ratio suggests normal valuation. A high P to S ratio means the market expects solid margin expansion or high growth. Value investors use PS carefully. Revenue alone doesn't guarantee profitability. It should always be combined with profit margins, free cash flow, and debt analysis. Price to free cash flow tells you how much you are paying for every rupee or dollar of actual free cash flow, the real usable cash the company generates. For value investors, this is one of the most important valuation ratios because free cash flow is harder to manipulate than earnings. A low P to FCF ratio usually means the stock is undervalued with a good margin of safety. A moderate P to FCF ratio suggests a fair valuation for a solid compounder. A high P to FCF ratio means the stock is expensive and needs strong future growth to justify the price. Because intrinsic value is based on future cash flows, PFCF connects directly to long-term valuation and helps identify true bargains. In summary, P to E tells you the price you pay for earnings. EV to earnings reveals the true cost of the whole business, including debt. P to S shows the price you pay for revenue. And P to FCF shows how much you pay for real, usable cash flow. As value investors, our goal is simple: find strong cash flow, low risk, and a meaningful margin of safety. These ratios help us separate real value from market noise. Thank you for watching. Please do subscribe and stay tuned. See you next time.